the car market bubble popped. We are familiar with the post-pandemic way of life and how slowly things return to normal. With inflation all over the news, a report from the Bureau of Labor Statistics in December stated that consumer prices rose at their quickest pace since 1982. Despite the post-pandemic recovery, 2021 held a surprise for the car industry, even if it was promising. Used cars were selling for more than their MSRP.
Now at 10, some used cars are selling for record high prices. That's thanks to a computer chip shortage.
Manufacturers experienced supply chain problems in 2021 primarily due to semiconductor shortages on top of low volumes and weak sales. However, how does that impact the average person? Although it does not necessarily affect everyone, costs for new cars have skyrocketed for those considering purchasing one. Dealerships are raising prices to the point that customers are paying premiums of 40 to 50% for new cars due to the low supply and strong demand. And it's not that brand new automobiles are becoming more costly. Although fluctuations in used car prices are common, a report from KPMG stated that used car prices increased more than 44%, while new car prices increased by about 13% in 2021. As the chip shortage continues to strike the world, restricting the number of new cars being built and sending new car prices higher, this forced car buyers into the used car market instead.
Prices are at record levels. The average cost of a new car has now topped $40,000.
It is not based on information from a crystal ball, but there are indications that the used vehicle market bubble may collapse in 2022. What caused the car market bubble? But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Thanks. Now back to the video. Although there are different factors to consider, the economy plays a vital role, such as whether or not the economy will continue to grow rapidly when automobile manufacturers resume production. If the production of vehicles returns to full capacity, but only to find out that demand has declined, this could lead to a surplus of vehicles. While the pandemic and everything that followed has resulted in a chain of events that have increased inflation, disrupted supply and demand, and created a global semiconductor shortage. The latter had a substantial effect on the manufacturing of new cars. You may have seen news of numerous finished automobiles awaiting chips, the sort that power the inside of electronics.
Well, Fox 2 has discovered thousands of brand new trucks and vans built at the General Motors plant in Wentzville, and they are all sitting idle in massive lots.
The vehicles still need the semiconductor chips that run their electronics and diagnostics.
However, how did it impact the cost? Prices usually increase when there is a shortage of supply. It is the underlying tenet of the supply-demand idea. Since there was insufficient supply, dealerships had to mark up the existing inventory, resulting in higher customer prices. Okay, but how could a spike in the cost of new cars cause the 2021 used vehicle bubble? Again, supply and demand are the key elements in this situation. The used automobile industry often depends on consumers selling their current vehicles to upgrade to a newer model. However, due to a shortage of supply and the majority of new automobiles selling above list price, consumers are delaying the thought of donating their current vehicles. As a result, the used automobile market has a shortage of inventory, and dealers mark up available listings. Therefore, the bubble. However, it is not just a matter of supply and demand. The cost of financing choices has grown due to the Federal Reserve raising interest rates to fight inflation. As a result, fewer individuals are now interested in purchasing brand new automobiles. Since vehicles are depreciating assets, auto loans are underwritten and designed to have negative equity throughout their terms. Before the chip shortage, a car buyer could expect their new car to depreciate by about 20% in their first year of ownership. Those who finance their purchase will likely owe more on their loan, than what the car's market value is after a year. For example, a $40,000 car will depreciate by 20%, and after a year it will be worth $32,000. Even though the selling price was $40,000, you likely financed more than that because of other fees included, like taxes and accessories. In hindsight, your purchase loan was actually $44,000, and this brings you to a $4,000 negative equity position. Experts are concerned about this scenario, since it might inevitably happen to consumers in 12, 24, or 48 months from now. Is the bubble about to burst? There is good news for those who have yet to buy a second-hand automobile. YouTuber Kevin Hunter claims that reliable data suggests used car prices will probably stabilize in the next several months. Although pinpointing the precise time frame is challenging, researchers believe you could start seeing the shift around the end of 2022 or the beginning of 2023. In his video, Kevin goes into great detail on why the bubble will probably break. He claims that since the start of the year, inventory at CarMax, one of the biggest used automobile retailers in America, has increased by 75%. Given the current situation, CarMax's inventory rise to 30 days' worth of demand is highly significant. Additionally, several OEM have begun to reduce the number of car options that depend on scarce processors, such as heated seats and auto-folding mirrors. This is done to enable the release of more new vehicles, while relevant manufacturers are expanding their output to fulfill demand and alleviate chip shortages. Lastly, the Federal Reserve raising interest rates has slowed down the buying of new cars.
What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations.
Due to the decrease in market demand, dealerships could stock more new automobiles. With used car prices inflated, consumers are financing purchases on used vehicles that aren't worth as much as they seem to be. The negative equity position they'll be in will be shocking. The first impact of the bubble bursting would be the reality of millions of Americans owing thousands of dollars more on their auto loans than what their car is actually worth. This will also have an effect on car sales in the future.
The basic economics is that the higher interest rate will make the automotive finance higher, more expensive for the consumer.
Return to normalcy would take time as long as supply chain problems, global conflicts, inflation, and a shortage of semiconductors continue to happen. Despite this, recovery will occur, though it is difficult to predict when and at what rate.